Let's begin with how the company was operating in 2013. What was the environment in which you were operating in?
Every businessman calls every year that's just passed. He refers to it as challenging. Yes, it was a difficult year. Certainly, devolution caused a lot of challenges, especially from a liquidity, a market liquidity point of view. We had the appalling Westgate tragedy. We also had the fire at Jomo Kenyatta International Airport. So not a pleasant year at all. But we were able to, fairly early on, we were able to see, look, we have a problem here, and we immediately pushed very strongly into the export market, just to keep the wheels turning, as it were.
Allan, you did say that the export market was a good cushion for the company last year. In terms of the countries that you export to, where did you see the greatest growth?
South Sudan was very good for us, but then that obviously went all pear-shaped in November. Still hasn't recovered, slight recovery, but still a problem. Malawi recovered nicely for us, and then also fell back because of the pending elections there. We did our first shipment into Djibouti. We did our first shipments into Sudan. We continued. We had some success in Zimbabwe. That also has fallen back. I'm not quite sure of the reasons just yet. But our traditional markets, like, well, we don't regard them as exports, export territories, Tanzania, Uganda, because we have subsidiaries there. They performed reasonably well for us, and we also opened up in Burundi, which was good for us.
Still on the export business, Allan, looking at some of the countries that you expect to reach, which are about 10 in total, maybe you can give us an indication in terms of expansion. What are the plans that are in store?
The Export Promotion Council has been very aggressive in terms of pushing us towards Angola and Nigeria. And certainly, those are two markets that we're going to look very strongly at, especially Nigeria.
Of course, expansion is also attached to a cost. How much are you looking at with these expansion plans? You did mention Angola and Nigeria. How much are you looking in terms of expansion plans?
It's not a big spend. Okay. It's not a big number. No. We're not producing there. All right, the production facility remains here. Our productive capacity is currently 40 tons per day, and we are currently producing at about 28 tons. So the export market is a great outlet for that unutilized capacity that we have right now. That's why it's very attractive for us, and that also is why we can apply a marginal pricing model to that.
Electricity is one of the major costs that whenever I speak to manufacturers, it's always a source subject. And most of them are now looking for alternative source of power whereby they're generating their own power. Is Samia planning to go the same route?
Problem is price. Problem is just price. If my plant was was located in South Africa or India, my electricity bill would be 50%. Okay. So obviously we have to look at alternatives. We took a look at solar power. Solar power is incredibly expensive, so we're not particularly pushing that agenda right now. What we are looking at very seriously right now is thermal power generation, coal.
Allan, let's talk about commodity prices, because we've seen a trend where we've seen the prices declining globally. If it's not steel, it is coffee, it is tea. Now, looking at it from the perspective of rubber, how are the prices sitting?
Prices 2 years ago were sitting at about $3,800, $4,000 a ton, and we're currently buying at $2,000 a ton. So it's been very good for us. That's natural rubber. Synthetic rubber, it's also come down in price, not as much. Carbon black stayed flat. So from that point of view, as far as our basket of inputs is concerned, yes, that has come down 18% in 2013 versus 2012.
Now, Samia has just ended a contract that you had with Japan's Bridgestone, and now you're looking into China. Let's talk about that.
We're not looking to China to come in as a technical partner. No, we have a licensing agreement with a Chinese company to produce a third brand for us. That brand is called Summit. So we will continue with Bridgestone as our premium brand, Yana as our high-price brand, and then we're going to bring Summit as our fighter brand or economy brand. So some of the tires will be manufactured in China. Some of those summer tires we will manufacture here. But that's purely a licensing agreement. As far as technical partnership is concerned, yes, we are looking for somebody to replace Bridgestone. Yes, we continue to be the Bridgestone, a Bridgestone distributor, but Bridgestone are no longer a shareholder in Samir Africa. They used to be, I think, a 14.9% shareholder, and in December 2013, they were bought out.
Yes, but what would be the impact if you're looking at Summit, which will be produced and manufactured both in Kenya and in China? Now, do you imagine in China it would be cheaper, and you're also looking for a new partner? What would be the impact to the business?
If we identify and bring on board a technical partner, we're also looking for a technical partner who will bring equity. We need to modernize our plant. The cycle times on some of our machines are just way too long. I'll give you an example. A truck and bus tire in China, they make 5 every hour. We make 1. So clearly, we need plant rejuvenation. The plant is very good quality, but it's old. Not so much that it's old, it's slow.
And how much would you be looking to raise from the equity partner?
Preliminary figures are between 2 and 2.4 billion, which is a substantial number. But yes, it will allow us to get our nose out in front.